Good morning, everyone. I'm Anthony Quinn. I'm the Chief Community Officer here at CARP and proud to be with you with a live audience today at the Zoomerplex. We're hosting a national webinar from coast to coast, and we have the CARP Toronto chapter members here in our office today. So glad to have you with us. And today we are talking about the gift of longevity. And here in our office today is Fraser Stark. Tell us your title, please, Fraser.
I'm the president of the Longevity Retirement Platform at Purpose.
And Purpose is CARP's national, CARP-approved recommended partner, so thank you for being with us this morning. And John, please tell us your title.
I'm John DeGuy, and I'm a portfolio manager and financial advisor at Wellington Altus Wealth Management.
Welcome, John, and welcome, Fraser. And welcome to our guests this morning and to the over 600 people joining us online today. We are hosting this webinar live, and we will take your questions on the chat form. Michael is monitoring the chat online, as well as we'll take questions from our audience. But we're going to David Kravitz. I forgot that David is here via video. David Kravitz is the
Hi, everyone.
Chief Marketing Membership Officer at CARP and is VP at Zoomer Media. Welcome, David. David is joining us from his home this morning. But I wanted to start off this meeting by sharing with you a conversation that we recorded last week. CARP President Moses Neimer in conversation with Sam Saif, and Sam is the president of Purpose Investments. And they sat down to talk about the gift of longevity. We're going to listen into that conversation first, and then we're going to come back to the panel and discuss what we've heard in that conversation and the questions that arise. So please run that video, and we'll be back to you shortly.
In my case, I was launching this youth-oriented channel called Much Music. You may remember it.
Very well.
Did you ever watch in your youth?
I did, very well.
So
Circus.
As we were going to air, I remember asking myself, well, can you still do this when you're 60? I was just over 30 at the time. No, I was older. That was when I launched City. But I remember asking myself, can you still do this? And in particular, because the cohort that I was addressing was identified with youth. We're talking about the boomers.
That's right.
And because they were young at the time, people thought that was what was important about them, and I gave them some youthful television and youthful television style. But I came to realize that what was important about them was not that they were young, but that they were a large generation, the largest generation ever created up to that point in time. That's when it hit me. And I applied for something called Zoomer in the late 1990s, at a time when the regulator was opening up to multi-channel television. I remember I put in 10 applications. They gave me 8, and they denied me the Zoomer one.
Oh, you're kidding.
Yeah.
It's amazing, but you had the forethought to do that because you saw the challenges of the waves. But, you know, I think it's a really important thing is that, you know, recognizing that, you know, when you can solve problems for large cohorts of people, but also not just the current, but it's like where the waves are going is really critical. And I think that's what, you know, makes for great opportunity for individuals. But that's also where there's a real social need, you know, whether it's in communication or in financial services. There's a demand need that needs to be met, and oftentimes the incumbents, the existing players who are in the industry or the business of serving customers don't actually see those changes because they're busy working on the things that they're busy doing.
And perhaps they're complacent.
Yes, right. You use the word, I didn't use it. But it's a very important word. Right. But that's exactly right. And, you know, I look at it as, I mean, so you look at the financial services today. So my other company that I founded was a company called, I co-founded a company called Wealthsimple, which was really around the starting point of the young individual who's just getting introduced to financial services. And they have a whole set of other needs. But when you look at the retiree, the individual that is just entering or you know, planning for this really important change in their life structure of, I will go to work, I earn an income, I pay my expenses, and then I have some savings, and I'm accumulating my wealth. You know, I'm accumulating savings in my accounts, I'm paying down my mortgage, I'm doing all these things. Then I go to this period where I don't wake up and go to work anymore, and I don't have an income stream coming anymore. And I still have those expenses, but I don't need to save as much anymore. Now I can actually use those savings to make my income stream. That's a totally different, complex beast and a problem that has to be solved.
Well, and now it's even more so compounded by the fact that we have this gift It's called extra life. We've been
yeah.
gaining life at the rate of 3 months a year since the end of the Second World War.
Yeah.
So the typical retiree now doesn't have reason to retire as much and may have another 20 or 30 years ahead of them. And suddenly everybody's afraid of outliving their money.
That's right. Well, and you know, if you actually get into the stats, they tell you that the average person lives till about 82, 83. But that's actually incorrect. Because if you make it to 65,
your chances are good.
you're actually going to, the average life expectancy is to live till about 88.
Right.
And then that's a 50-50. That's the average.
Yeah, no,
So,
and if you hit
yeah,
85 or 86, apparently your chances of hitting 100 are
that's
excellent.
exactly.
Yeah.
And so, you know, the reality is, and by the way, this is good. This is a good
This
thing.
is good news.
Yeah, it's a great thing.
We forget that.
We forget that because it means more life. And it's actually the most beautiful life because you've stopped having to work every day. You can now enjoy all the activities and things that you've kind of done all this work for. And so it's a wonderful thing. But it's also, on the flip side, a very frustratingly, I'd say, insecure moment for many people because of this one problem. Is I don't know how long I'm going to live, and I don't know how much money I have, and I don't know how much I'm going to need, and I have no idea how it's all going to play out.
And
so the insecurity.
fear of
Yes.
poverty in old age, I think, is deeply ingrained in the DNA.
That's right.
And we're only recently out of a period when there was widespread poverty among older people.
That's exactly right. Well, and I think it's going to continue to be a real challenge unless there are more social structures. I think the government has to play a big role. And by the way, they've done some fantastic things with CPP. CPP is a wonderful program. I mean, we are very lucky to have CPP in this country. And, you know, you look south of the border and we don't have some of these things. So Canada is very lucky there. We have OAS, you know, Old Age Security, which is a government-funded program. The CPP is funded by, of course, you as an individual. We all funded into it.
Contribute to it, yeah.
But OAS is funded by the government. But
then there's a little GIS if you're
exactly,
needy.
Exactly. But that doesn't solve the real, like for most people, it doesn't cover your basic income needs. So it doesn't, I mean, cover your food, shelter, transport, and health needs, healthcare needs as you get into age. And so what ends up happening is most people actually live a very insecure retirement. Even though they've worked all their time, they've had all this great time, because they're worried about this, they actually go into retirement very nervous, and therefore they either are too conservative in retirement, they don't enjoy themselves, they don't go on those trips, they don't go spend time, you know, they don't give away any money to charity, they don't have all the fun that they've kind of built and they should be, because they're so worried about
And
running out.
now, inflation's a new factor, isn't it? We've had 20 years, maybe a little more, where it wasn't at all.
40 years.
40 years.
Yeah.
And now all of a sudden it seems to be raging. And in part, doesn't that mean people can no longer have that dream cliche retirement? Once upon a time it was 55. That's long gone. But even now, more and more people are needing to work. And then there are people like us and my organization, CARP, which advocates that people stay engaged.
That's
it
exactly
tells
right.
them they should continue to
Well,
work.
you know, I think there's a few things. One, if you're 65 today, you've lived through inflation in the past. You know how nasty it is. You know, we had rampant inflation in North America in the 70s, and so you understand what that meant. You knew what, you know, higher cost of living was, and, you know, you knew what cost of a mortgage and all the, you know, the debts and things like that, the interest rate costs. And so you understand how nasty it is. And we're not, I will say that, you know, we're in a higher inflation moment because of a large part of what we've gone through in the last year or two with the pandemic and all the capital that's invested. We've got inflation because of some of the structural supply chain issues and things that are going geopolitics around the world. I don't believe we're going into a world where inflation is going to be like we saw in the 70s. And so that's a very, hopefully, comforting thing.
We're not dealing with the Weimar Republic here.
That's right. But I do think...
I do remember 18% interest rates.
That's right.
Yeah,
Remember
so that was in the 80s,
That's
wasn't
exactly right. Interest rates were 18% for a mortgage, and inflation was sort of 15, 16%. That was correlated.
That was shocking for Canadians.
That's right. But the one thing I will say is that we're not also going back to the world that we just came from, which was 2%, 1% inflation rates, which we've all really gotten comfortable with and enjoyed. I don't believe we're going into that environment for some time. And I think, we're likely going to be in an environment where inflation will be in the 3 to 5% range and I say medium term. And that still is nasty for individuals. If you've got, and the other part is, what we don't talk about is that inflation for a retiree, because of the basic income elements where inflation actually is more rampant, versus, the average person is actually higher. So in food inflation is a more nasty part of it. Gasoline, so transportation, exactly, housing costs. These are where inflation actually is, in healthcare. Of course, we've seen healthcare costs going up quite dramatically year over year, even pre this year. So I think that for a retiree, these are real cost increases.
Let's try and add up the elements. We all benefit from CPP. Many of us benefit from OAS. Those who need get a little of the GIS. But taken all together, that gets you to about, what, $35,000 a year?
Yeah, for a single, an individual,
right.
You're probably about $20,000 a year through government programs.
Couple.
That's right. For a couple, it's about $39,000 to $40,000 a year.
So that is simply not enough.
That's exactly right.
So now you have to add personal saving, maybe a little additional work, which could be a good thing because we're also reading headlines about a shortage of workers all of a sudden
That's right.
in our economy.
And experienced workers too.
Right.
That's a really good thing.
Right.
So first is to, I always say, Moses, is the most important thing someone should do is have a plan. But if you look at it from the individuals, there's also then planning for how do I develop an income stream from these different things. So CPP OAS is your foundation. Then maybe if you've got a defined benefit pension plan, that's second. If you don't, then it's your assets from your investment accounts. And the number one thing you want to solve for is what's your basic income needs. So we talked about if you're a couple and you get $40,000 a year from CPP and OAS, let's say you needed $60,000 a year today, in today's dollars. Inflation will make that a little higher. Well, then you've got a $20,000 gap you got to solve for. And that's where doing some income planning.
And that's where longevity
comes in.
All right,
and
we've been a long time circling it.
Exactly. And
Can
so it's
you
really important.
Quickly explain it, and I know it's not an easy thing to explain.
Yeah, the best way to really tell the story about longevity is it's the first mutual fund in the world, actually, but we did it and built it here in Canada that allows for the creation of income for life that matches the length of your life, no matter how long you live. And it does it by pooling together the benefit of multiple people all solving for the same thing. How do I get an income stream for no matter how long I live? And so how that works is that, an individual, let's say at the age of 65, we pay 6.15% to start, so 6.15%. So if someone puts in $100,000, they'll get $6,150 a year paid monthly for as long as they live, and that will fluctuate, but more than often not, we've designed it to go up over time. And so that's a very important thing. So over time, the investor will get more income as they age. And then what's really critical there is that, so if you put in $200,000 or $300,000, you'll get multiples of that. So if you needed $20,000 of more income for you and your spouse, then you would put in somewhere in the neighborhood of $300,000 into longevity. And then any excess savings above that, you can build into a nice diversified balanced portfolio or asset portfolio that can use to support your discretionary spending. So, and why this is relevant. So in the event that we go through retirement, every year you want to be taking your income stream. But let's say you go through a period where the markets are off, bad, like we've seen today in the markets this time right now. Those are years where you can actually defer your, call it discretionary spending. So that big trip that you want to take, the fixing of the roof on your garage, putting an extension, paying some charitable gifts, or buying gifts for somebody. Those are all, call it discretionary elements. You can time those, but you can't time those basic things. So what the CPP, OAS, longevity do is they give you the knowledge that you can always have in good and bad times in markets, your non-discretionary spending covered. And then you have any portfolio assets you have over and above that can now be used for, if markets are going well, you can use that excess
So
returns.
you're positioning longevity as a kind of must-have rather than want to maybe have.
That's right. Well,
it's part of the basic.
That's right. We look at it as a part of a plan. It's not 100% of the problem, the solution. It's a part of the solution. So it helps someone design a very specific program. And I go back to something I said earlier. When you get into retirement, your hierarchy of needs change than where you were when you were pre-retirement. Your hierarchy starts with, I want financial security, and I need to know that that financial security, that income security is going to come in on my basic income first. Once I've solved that, then I'm solving for the next layer. Maybe I want to create an income stream for paying for healthcare bills that I want to make sure of, or I want to pay for trips every year. Well, you can layer in those as well on top of it. But the number one thing we always say is start with your basic income needs, the things that are non-negotiable, the things that no matter how good or bad the environment around you is, you have to pay for. And that is food, shelter, transportation, and healthcare. Those four things.
And a little bit of fun every once in a while, just a bit.
I agree with you. And it's always nice to have a little bit of extra money for some fun.
Here is a deep and abiding issue I've encountered throughout my work in this new phase of my career. This is after City, after much. And here I am at Zoomer dealing with the same demo I used to deal with then, but of course they're now 30 and 40 years older. And I'm referring to the psychological problem that people have dealing with aging and the ultimate end of aging, which we all understand is dying. How do you get people to focus on the solution that longevity is to that problem?
Yeah, I mean, it's actually the most important component of it. It's because when you go into retirement, you have two variables you don't understand, you don't know. When you're in pre-retirement, you have one variable. Is the market's good or bad? I can always delay my retirement age based on how that variable works. But once you decide to go into retirement, there's two variables. One, how are the markets going to do? How will my investments do for me? And two is, how long will I need the money for? And so this actually becomes a very important factor that most people have to start paying attention to. Am I going to live for 3 years, 10 years, 20 years, 40 years, 50 years? And you know, if you're lucky, you'll end up in the higher end of that.
Didn't J.P. Morgan now tell their their advisors a couple of weeks ago that they need to treat all customers as if they're going to live to 100?
That's exactly right.
They did.
And in fact, you know, that's the right advice. Because if you go back to what we said earlier, the average individual, when they hit 65, will live till about 90. That means that half the people will live past 90, and more often than not, you know, there'll be lots of people who live to 95 or 100. So you have to assume everyone will live to 100. Because if you don't, then you don't know which percentage. And one of the things that I always say is, as an individual, you are planning for retirement on your own. Like you and your family, your spouse, you're planning for retirement on your own. What things like longevity do, and by the way, defined benefit pension plans do, is they pool people together. And they underwrite that long-term plan with a group, all trying to solve the same problem. And when you put groups together, you actually can have a higher probability of success of averages, because you know the average will actually occur in a group, not on an individual. So it's really important to think that way. But you asked the question about why when you know you get into retirement now, you want people to think about this idea of when will I die, and it's an important question to ask and understand. Some people, you know, unfortunately, if they live an unhealthy life or they have, you know, and more knowledge about that, they do have more sight. But what's actually, there's great research that's shown that unless you believe or have a view of the next 5 years of your life, of you know what you think will happen, beyond that, your probability of being able to get it right is actually very low. So most people cannot forecast beyond 5 years. You would know, you know, for the most part, if you're unhealthy or if you've been diagnosed with something that could shorten your life within the next 5 years. But beyond 5 years, your guess is as good as anybody else's that you could live for 10, 20, 30, 50 years. So it's really important to recognize that you know, that is an important variable when you get into retirement, and it's an important variable to understand. And when you get into retirement, most people are actually going to have to think about planning, not for 5 or 10 years, but actually for 40 years or 50 years, as you put it. And if you plan that way, then you start getting into, okay, how are we going to make this work for 40, 50 years?
it's hard to get people to focus, and I'm speaking from personal experience. I mean, I'm constantly giving the advice that you ought to get your affairs in order, but constantly putting it off for next weekend and the weekend after that. So longevity is there to help people focus now.
That's right.
What would motivate someone to start putting money into longevity before the age of 65 when they can begin to draw out?
Yeah, so actually, you know, your point, it's the same as a 25 or 30-year-old. So getting someone to start, you know, managing their affairs and start thinking and planning for retirement actually starts when you get your first paycheck, I always say. But most people actually don't get organized. And it's, you know, this is something I've thought a lot about in my career because, you know, I want people to get their plans in place when they're 20, 25, and I want people to be organized when they're 30 and 35, and I want people to be on the right track when they're 40 and 45. But, you know, what I always say is no matter where you are, the best place to start is now. Like, start tomorrow, you know. Start with your next paycheck. So why someone before 65, before they get to that age of retirement, would want to, you know, start focusing on longevity is the same reason why, you know, pension plans are so successful for individuals. If you're a lucky one who worked for a corporation that had a defined benefit pension plan, or, of course, all of us got the benefit of the CPP, is that it was a discipline. That every single paycheck, no matter what you planned or didn't, a piece of that went into your pension plan. A piece of that went into CPP. And you sort of planned X all of that. And so what the nice thing about longevity is it's designed so that if you're before retirement, you can start using this at 20 or 30 or 35 or 40 or 45 or 55, 3 years before retirement, whatever it is. And it starts to accumulate, and you make a discipline around that. You make it come out of every paycheck, or you put a lump sum, you know, if you want.
So you don't have to put in the whole 100 all at once to get that 6,000.
Exactly. And so you can build it up, and it keeps accumulating just until the day you decide that when you turn 65.
It earns interest on
returns.
The deaccumulation.
Exactly. It earns a return on the portfolio, just like it would if you were invested in a normal portfolio in the markets. And so that gives you the ability so that every time you put money into it, you're actually developing more return opportunity. And then when you turn 65, what we've designed into longevity, which is really, really cool, is that the month you turn 65, it flips from accumulating to the decumulation. So it now starts to pay it. But it does it on a tax-deferred basis. So it doesn't pay, you don't trigger a tax at that moment, just like you would if you were in your RSP or anything else. So that's a really important thing we designed into this. Is one of the nice features. And that's why I think it's really cool for a 25 or 30-year-old or 55 to start using longevity as their savings mechanism to build up their retirement pool.
What is the guarantee that, well, some say stays with this, doesn't disappear, doesn't run off, doesn't die prematurely, or that the company is solvent? What is the guarantee?
Yeah, what's really nice about, and just like any other investment fund, it's not about purpose. We've designed this, we manage it, but in fact, you know, anyone can manage it. And so it's really important that, like, you know, purpose, if purpose was not for any reason to be around or was to be insolvent, which, you know, we're no concern with that. We're building a very enduring long-term firm. You know, someone else would just come and run this. So another money manager would come and run the longevity pension fund.
So these are segregated
segregated
funds,
assets. Yeah. They have nothing to do with purpose. We're just the manager. We basically manage the assets on behalf of the longevity pension community, the individuals who are part of the investment community of longevity. And that will happen for as long as we can, and we will. And for any reason, if purpose wasn't there, SOM wasn't there, it's not about me or purpose, it's about the pool, and they'll be managed by somebody else who will do the same job. So the worst case scenario is that some other manager would come in, but my hope, my dream, and the business that I've built is to build an enduring firm that lasts for hundreds of years for all of the longevity communities over time.
Yes, yeah, from your lips.
Yes.
Wow.
Well,
that might be a...
It's an important thing, Moses. Like, you know, as an individual, you know, I'm 46 years old. Today's my birthday. And I would say, you know, I've been doing this for a long time, thinking a lot about how do I create endurance, not just short-term, but endurance. And this is a really important one. You know, as I thought about designing a product for, again, individuals who are going to live for 50 plus years, you have to think about building an organization that's going to be around for 50 plus years. And in 10 years, all the new investors who come in, that's another 50 years. And you have to think that way. And you look at firms like Royal Bank, and you think about JP Morgan, you used JP Morgan earlier. These are organizations that, you know, when their founders were originally creating the organization, they had the goal of creating an organization that was going to be around for 100 plus years. And of course, they've been able to do so. And I think that's a very important thing to me.
I think that's something of great reassurance to people who are looking to your fund and your management of it to provide that missing gap in the security that everybody hopes to have as they get older. So, yeah, congratulations to you for having innovated something that is literally unique in the world. That's quite something, Sam.
It is, and it's not seldom, it's very seldom, I should say, that we as Canadians can say we did a world's first, but I'm proud of it. And what's been amazing, Moses, is that, you know, sometimes as Canadians we don't have the boldness to think globally like that. But this is one where we've actually seen interest globally from some of the biggest players in the world saying, we wish we had what you've done there, and we'd like to do this in Australia and US and Europe. And that's great.
Well, with time, they'll come. They'll
that's right.
seek instruction.
But first is we're doing it for Canadians.
Canada.
We're doing it for Canadians first, and that's the most important thing.
Bravo. On behalf of CARP, I say bravo.
Thank you very much, Moses.
Right.
Thanks. We're back live with Fraser Stark, the president of the Longevity Platform at Purpose. We're with John DeGooey, Senior Investment Advisor and Portfolio Manager at Wellington Altus. And David Kravitz back on the screen with us virtually, Chief Membership Officer at CARP. David, welcome. I learned a lot in that conversation. Having the president of CARP and the president of Purpose talking, I thought, really sets up a stage for us digging a little deeper into what this product is about and what the issue our members are facing. For many years, our members have written us, talked to us, met them right across the country, telling us that they're concerned about outliving their money. The first question I want to ask you, Fraser, is following on something that Sam said, that it's unique in the world. Why is it unique, and how did you come up with this product?
Yeah, it's unique because Purpose deliberately innovates and sets out to address tough challenges. The idea of longevity risk pooling is not unique. That's existed for centuries, in fact, and decades in a more modern sense. But what's unique here is the ability of an investment fund that's available to everyone, in this case in Canada, to incorporate that principle and ensure that people who didn't, through their employer, have a defined benefit pension plan have much of that same concept of an income stream that'll last as long as they do. So it's unique in the delivery of it and the structure of the product, but it relies on long-standing and global principles.
But it's a mutual fund.
It is.
So it trades or purchases like anyone else would buy a mutual fund for their portfolio. John, you're our expert here on that. How would someone go about investigating and purchasing for their own portfolio this Purpose longevity product?
What you do is you have to find an advisor who will recommend the product. And I would say enlightened advisors are aware of all the things that Moses and Sam were talking about, and they would therefore try to solve it because it is one of the very most pressing financial planning problems that we've had vexing us for a generation or two. So the advisor would then be able to find a way to incorporate it into the investor's portfolio, the client's portfolio, at a judicious amount, not everything, not nothing, but some portion that will be one of the sleeves to provide that income that's needed for as long as they live.
Okay, we'll dig in deeper into how it might fit into someone's portfolio, but David, maybe you can frame what this gift of longevity means to us. We talked a bit about, or we heard a bit about, how long we may actually live, and if you hit 65, your numbers could increase. But you are our expert on super aging, so tell us what problem we're really solving for here.
Well, I think, excuse me, I think what's happening here is that Sam and his team have articulated a phenomenon that is changing the entire model of financial planning. Don't forget that the model was based on those 10 to 12 years you had after you hit the age of 65, and 65 was defined as the arbitrary age of retirement. And so the model, which dates back to the post-war, you hit the job market in your young 20s, you work for 40 years, or so, you cash out at 65 and you've got enough money left between your Canada pension and your other pensions and whatever else you've accumulated, you have enough money to last you for those 10 to 12 years before your demise. And everything was based on that. When you retire, how much you need, how much return on the investment you have, the whole idea being very conservative as an investor after 65 because you haven't got time to recover from any market disasters. And that model was ingrained in our workforce, in our retirement legislation, in our pension structure, and in the way financial planners themselves approach their job. And now all of a sudden you're looking at 20 to 30 years, and we're just starting. We're just starting on that. That's going to get even more and more. And all of a sudden you say, well, how am I going to accumulate enough money if it's a 40 years of work from my 20s to my 60s? Can I accumulate enough money to last me another 30 or 40 years, or maybe even longer? And the answer increasingly is no. And so what we're seeing, and where I think this concept, purposes concept is so powerful, it plays into, is everybody's now looking, and this would be my message to our audience, from CARP, but we're not financial advisors. We don't know that this exact thing is exactly right and what dollar amount for everybody. That's outside our realm. But where we are enthusiasts of this is you now have to look at a wider range of possibilities for yourself if you need to indeed go for 20 or 30 years or more. And that includes, and Moses touched on it, continuing to work, maybe full-time, part-time, side hustle. A lot of people are doing that, A, because they want to, B, because they need to. New forms of investment, such as this longevity fund that we're hearing about. So you have to keep your eyes open to a wider range of solutions. And I think the challenge for financial planners will be to break the mold of the former model and embrace the longevity model. And we'll see where that goes. It's going to be very exciting.
John, David just mentioned the role of financial planners in this. How would you broach this product with your clients or with anyone listening on our webinar today? What's involved and how would you recommend it, and where does it fit in someone's portfolio?
It fits for virtually everyone, especially people who are healthy, who expect to live a long time. A lot of people don't realize, but the returns that we've been able to enjoy for the past generation are not likely to persist going forward. All the best planners are saying that the expected return for a balanced portfolio, 60% stocks and 40% bonds, is probably between 4 and 5% before you pay the advisory fees and product costs, which means net of that, we're looking at about a 3.5% rate of return, maybe, if we're lucky. And that kind of return means that you have to think about, well, what if I live to be 95, like the people here are talking about?
Sounds like
exactly.
It's really on the horizon. It's a possibility.
Exactly. So now we have to proactively insert products such as the Purpose Longevity Fund into the portfolio so as to mitigate that risk. It's not just the risk of uncertainty of the sequencing of whether markets are up or down this year or next year. It's also the risk of, irrespective of whether markets are up or down this year or next year, will I have enough to last me the next 25 or 30 years? If people retire at 65 and live to be 95, that's a 30-year time horizon, and we're touching on it, and we need to say it explicitly. It's a very real risk that a lot of Canadians are facing right now, and their financial advisors are oftentimes not talking to them about it. So they need to have that conversation. And a lot of people, it's funny, I'm actually writing a book about optimism. People are optimistic about markets and optimistic about a whole bunch of things. They're not optimistic about how long they're going to live. They actually think they're going to be dead tomorrow. Like no, your life expectancy is actually probably longer than you think, and you need to start planning, doing a financial plan, working out the numbers and mapping out what this is going to look like and whether or not you have enough to last you, especially those last 8 or 9 years that you probably didn't think you were going to have.
Well, we at CARP would call this the gift of longevity,
right, yeah.
But you're calling it the risk of longevity. Fraser, when you try and solve this problem or this gift for people, why hasn't something like this come to the market in the past if we've known this demographic has been coming since the late 50s, early 60s? It's been a massive generation, as Moses said. They've been coming for a long time. Why has it taken so long for something like this to happen?
There's been innovation happening in different ways. You know, this exact structure is coming at the tail end of a decline of defined benefit pension plans over many years. So defined benefit pension plans peaked in the late 1970s and have been steadily declining since. Depending on how you measure it, there's different numbers of people that have access to them today, but very few workers have access to invest in a defined benefit pension plan. And so it's clearly the time to address it with market-based solutions, and that's the approach we've taken.
So if you're not a government employee or a teacher or someone who has that defined benefit plan where you may not require an additional pension-like investment,
right.
this takes that place.
That's right. We designed this product for people who wish they had a defined benefit pension and saw the benefit of it. And the structure's a little bit different, but it's there to fit that role in someone's portfolio. And in fact, many of our early investors are actually people with defined benefit pension plans who, seeing the power of that structure, are saying, I've got some savings. It'd be great if I had more. Once people see the power of income and the knowledge that it will last, they're able to live their lives differently and frankly better in some ways.
David, at CARP and Zoomer Media, we've always talked about the market not serving our members or not seeing the needs. Is this sort of a response to CARP and our members, Zoomers in general, asking that they pay attention to our needs?
Well, I think it is, but I think the industry, particularly the financial services industry, is really starting to recognize that it needs to change its own model and look at many more topics than they have before. And I want to come back to something Sam said in his interview with Moses, which was you need to have a plan. What I would say is that the plan itself needs to look at many more things than you used to look at before. And we've had other webinars here, as you know, Anthony, on aging in place and the technology of aging in place. How are you going to be able to afford? Do you want to stay in your home? And that's going to involve all kinds of technology that's just coming onto the market now. So having a plan that factors longevity into it, it's not just here's how many more years. Therefore, on an Excel spreadsheet, I got that many more columns, for each year. It's what is the makeup? What are the ingredients of that spending? And how am I going to supply the funds for those ingredients? And I think that this fund, longevity certainly will fit into that if you take a look at it. But I would encourage everybody to hear the word plan and be aware that you have to look at healthcare, you have to look at independent living, you have to look at healthcare costs, you have to look at funding of technology, because if you think you can live longer now, wait till you see what's already on the drawing boards for even more that will keep you living even longer if you can afford it. So it's going to need a deep dive, and I think that the financial services industry will become the quarterback of that. They're starting to create certificates of special training for financial advisors who specialize in dealing with seniors, and you can look for that if you want. But I think the conventional model of hire me as your advisor because I can get you 5% return and the other guy only got you 4 7/8, that's dying. I think it's more like look at all the range of ideas and analytical tools and plans. I can help you plan your total life as somebody living longer.
John, have you seen that? Sorry, David.
When that plan happens, then the longevity fund will make even more sense, I think. But I think I'm encouraging people to think broadly about the word plan.
John and Fraser, have you seen the industry changing over the last number of years?
There's no question that the industry is moving in that direction. I think the question that we have to ask ourselves is it moving quickly enough? So there's a recognition, it is happening, but like so many things in life, we would like it to happen more quickly because it's more urgent than the industry seems to realize, and it seems to have caught the financial services industry a bit flat-footed. But I couldn't agree more. Good financial advisors, good financial planners, talk about all the contingencies. They start saying, well, what if I were to downsize my home? What if I were to go into an assisted living program? What if I didn't live as long as I do? I have insurance in place? All these sorts of questions that you need to think about, a good advisor will help you to focus on the total breadth and depth of planning for your future, whatever that might look like and whatever may come, because nobody knows for sure.
So Fraser, what else is happening on Bay Street?
Well, as John said, it is moving. It's just not moving fast enough. And to David's point, a plan is not a portfolio construction. That's a component of a plan. Where the plan exists is where the portfolio meets the person's life. And the plan has to work in a wide range of scenarios, because no matter how certain someone is that they're going to live to 92 because that's how old their grandparents lived or whatever data they have, there's a huge range of uncertainty. I recall some research done recently that said if you ask people at retirement age how many years left they have, they actually on average get to approximately where it is, around 88 years old. But if you then ask them, what's the chance that you pass away that year, 40% of them think they will. And the true answer is only 4. So they're thinking that the distribution curve looks like this, and really there's a huge range of possibilities. So your plan has to work if you pass away the year after you make it. It has to work if you live, as the oldest Canadian ever did, to 117 years old. Now, you wouldn't want to plan to stretch your assets to 117. That's not an effective way of doing it. You'll be living on far less than you could, but you've got to find tools that can accommodate that possibility, and that's where longevity fits.
So I heard Sam Safe, the Purpose CEO, in our conversation earlier, say that you could get into this product in your 30s, 40s, 50s. Who is it actually being marketed to? Who would you, John, advise to start looking at it? And when are you too old to join this product?
Yeah, the product is being marketed primarily to people 65 plus. That's when the longevity risk pooling starts, and that's when the longevity pension fund really takes on a very unique element to it. The version that's available for people that are under 65 is an accumulation vehicle. It's called the accumulation units. And it's a great tool. It allows someone to save for retirement, knowing that they're already thinking in terms of income for life once they retire. And that's a powerful mental shift for someone saving. We're finding investors in the fund at all ages, but of course the majority are coming in the decumulation units for those 65 plus. The investors in the fund are cohorted in 3-year groups. That's the group across which risk is pooled. The oldest group we're able to take investments from is people born in 1945. So unfortunately, anyone born in 1944 or previous is not eligible for the fund. And anyone can invest in the fund until they turn 80 years old.
Until they're 80, okay.
Until they're 80.
We're getting a number of questions coming in from our webinar participants, so thank you very much for those. And one is about the security of this investment. So is it a guaranteed investment like something like a GIC or something like that?
It's not. It's an investment fund, so more similar to other investments that someone has, a balanced fund, individual mutual funds or stocks. A guaranteed fund is an annuity, and those are great products, and they're a good tool in the retirement planning toolkit. However, the guarantees bring limitations. And so while an annuity is guaranteed at a set level, our fund is designed to rise over time. We've invested the assets very conservatively. It's diversified geographically across asset classes. There's a sleeve in the fund that's designed to respond positively in inflationary environments, and in fact, that's working in this environment. So we've taken a very conservative approach to managing the investments, but an investor in longevity is still able to benefit from the longevity risk premium, the difference that markets tend to produce over time relative to the risk-free rate.
John, please.
I would add that the other way of answering that question, also an answer, but a bit different from what Fraser is saying, is that all mutual funds, all exchange-traded funds are covered by the Canadian Investor Protection Fund. So the investor should have the confidence that there's insurance, just the way we have for your bank deposits from CDIC. There are similar sorts of assurances in place that are government sanctioned that will guarantee that you're not going to lose your money as a result of any kind of insolvency like that. If that's the way the question was asked, I'm not exactly sure what they asked about being, guaranteed.
Well, I guess
but
a
that's
pension may be considered to be guaranteed,
Right.
And this is similar
That's right.
in that it's investing in the market and it's lowering its risk so that it lowers your risk of.
That's right. And pensions define the amount that they're going to pay. That's the defined benefit portion of a DB pension. There are times, of course, when they fail to meet their obligations because they're sitting on an investment pool as well, but those are rare, and people with DB pensions can rely on those as highly secure. The way we've structured this is it is a variable pension. The distribution rate will be analyzed annually. We've published the way that we will analyze that, the way market returns and mortality experienced will affect those rates. And we've done modeling with LifeWorks to show across 2,000 economic scenarios how the fund is expected to perform. And the great news is that non-guaranteed doesn't mean it goes down in most cases. In fact, in most cases, in the average scenario, the fund over 35 years more than doubles its distributions, which when you do the math on that, it equates to about a 2.1% annual increase, which is roughly in line with long-term inflation rates. Not current inflation rates, but long-term inflation.
Question coming for you, John. How can someone find a great financial planner? What's a recommendation for them?
Well, there are a few websites that you can go to. I think you should maybe ask the people over at FP Canada. So FP Canada is the organization that offers the CFP certification. There's FPAC, which is the Financial Planning Association of Canada, which is a membership organization, which I belong to, which is some of the best financial planners. I think you want someone who has a CFP, a financial planning background. You don't have to, but I think that would be one of the things that you should look for. So when you're interviewing someone who might be an advisor, there are 85 or 90,000 advisors in Canada, but only about 17,000 of them are CFPs. So I think that would be a helpful place to start.
And another question coming in for both of you is, how is this taxed? Can it be held in tax-deferred accounts, or is it taxable?
It can. It can be held in a cash account. It can also be held in a variety of tax-deferred accounts, RSPs, TFSAs, RIFs and LIFs, a variety of tax vehicles. It has to be held associated with one person, so it's not suitable for spousal accounts. That's because it ties to a single person and their life.
And if someone is a self-directed investor, can they buy without a fund manager?
They can buy it directly through a number of online channels, yes.
Okay. David, let's get back to this issue that our members have brought us around the table, the concern about outliving their money. We've got the CPP, the OAS, if you're in lower income, the GIS. Talk about other ways, David, that people are actually supplementing their income beyond 65 and the traditional retirement age.
Well, this is actually our message for, from CARP's standpoint. Go broad, go wide, consider more options, open up your thinking, as opposed to this one thing is the new, this is an excellent plan that we've heard about today. Obviously, we're proud to be associated with it, but the problem of outliving your income goes very wide. First of all, what is your income? What is it that you're outliving? What are you spending it on now? How much of it is tied into employment? We're seeing a lot of people, as you know, we've talked about it before, not retiring at 65, wanting to stay working because they enjoy it. Never mind that they need the money, but so the whole culture of this kind of automatic 65 being midnight gone, that's finished. It's never going to come back. So now we're seeing retirement at 65, semi-retirement at 65, side hustle, small business, home-based business, all of the above, reinvention into a whole new career, because that actually can contribute to longevity. So the paradox is keeping on working can actually help you, if it's the right job and the right environment, can help you be healthier, more engaged, and contribute itself to longevity. So there's income from employment. Where is it written that it must dwindle down to zero? The second thing is, what other sources of income are there? And there are, I'm just surveying the landscape, these are not instead of funds such as the longevity that we've heard about, but maybe in addition to. There's millions of dollars of asset value, as we all know, in real estate, and reverse mortgages, which used to be kind of not quite understood or a bit of a no-no, have become very mainstream now. They've become very much an accepted strategy to look at. We have a very excellent partner at CARP in that area, but we don't say, go get a reverse mortgage. Just look at it, open up your thinking to these alternatives. And I think that a well-informed, thoughtful plan, I don't think the folks at Purpose and Longevity have anything to fear from a person approaching them with such a plan, with such a perspective. I think they would welcome that. And that's what we encourage at CARP. Think more broadly, think more deeply, and treat it as something exciting rather than columns on a spreadsheet. What are you going to do with that 20 or 30 years? How are you going to make that exciting? It's not just grinding out the pennies, although those are important. It's does your plan include lifestyle? How do you want to live? What do you want to do? And our message to our members is to be very unafraid of considering a lot of different options when you do that plan.
Daria, I'm going to ask a question from the audience next, but I have one here. Did you want to add something to that, Fraser?
No, that's okay.
Okay. The question was about the expense of purchasing this fund, the MER, the management expense ratio. How much is it? How does it compare to other mutual funds? And I understand there's a discount for CARP members. How does that play in?
There is a discount. The management fee on the fund is 60 basis points. Total MER is 73, I believe, with the operation costs and taxes. The discount for CARP members is 15%, so it takes the 60 basis point management fee down to 51. It's a great program, and many of our investors are taking advantage of it.
Great. Daria.
Yes.
There was a question in the audience. This gentleman right here.
Oh, hang on.
Me? Oh, okay. Okay, question. To get this fund, it is a fund, you have to go through an investment advisor.
Not necessarily.
You don't have to. We encourage people to seek financial advice before buying into the fund. Some people do so and then buy directly through a direct channel or an online broker. Other people invest through their advisor. So you have both options.
But there's still a third party. We're not dealing directly with you.
You can deal directly with us. We have a financial planner as part of Purpose, and so anyone who reaches out to us on our website, we're able to put them in touch with the planner. But most people are investing either through their current advisor or a direct channel through a bank or an online broker.
And as I also heard you say that there's a 0.5% charge per annum on the fund. Okay, and if I was dealing with an investment advisor and I was putting $900,000 in, I'd probably be paying the investment advisor 2%.
There's a range of those fees.
Well,
Yeah.
usually that would be what the level would be. So right off the bat, you've got 2.5% that is going every year because you are dealing with your fund. Now, if you were doing it directly and buying financially strong stocks, paying high dividends, you would be paying virtually nothing compared to the 2.5%. And you could still be getting a 6% return and seeing a capital gain of approaching 13%. Is that your competition?
Well, John, that's the question that I hear the most about this product. How does it match regular, typical investments someone might have?
So I want to push back on the 2%. For me, if I have a client at $900,000, I'm charging less than 1%. So again, it's not nothing, but you have to shop around again. But I think you can get really good quality advice for not as much as you think. And if the money is not registered, it could be tax deductible as well. So there's a lot you could do there. The competition, but back now to the question. If you're building a balanced portfolio and the contents of the longevity fund is a diversified basket of stocks, bonds, alternative assets, what have you, but it's pooled together to manage the risk, as Fraser was saying. You could buy the disaggregated parts individually and build something similar.
But you don't get that pooled.
But you don't get the benefits of the pooling. So what you get is the same sort of risk-return trade-off. The cost may be higher or lower depending on the cost of the parts that you build build it in your basement kind of portfolio versus the standalone longevity fund. But the big difference is you don't get the risk pooling. And that's what we've been talking about the whole day is the big leap forward that Purpose has taken with this product is that by risk pooling, you manage to take away all of that risk of if you have 2 or 3 years in a row where all asset classes are going down, you're not going to get hit with this product the way you would if you built it on your own. And I think that's the big difference.
I think we have a follow-up here from the audience.
Yeah, follow-up. I'm 78 years old. I've been retired for 18 years. I invested my money. Every year it grows about 13% a year. I don't worry about being 95 years old because every year it is growing. I don't worry about the price of stocks in the stock market either because what I'm living off are high dividends. I'm very carefully choosing the stocks that I want to get. So I find it interesting that this whole thing is, oh, geez, we're going to live to 95 or 100 or whatever. I am 500% ahead of where I was at 60 years of age, and I believe that anybody can do it. They just need to be educated. And unfortunately, the investment industry isn't going to do it because you've got a vested interest in getting your commissions. And I guess that's the way I see it.
So we half agree, and I've done a lot of work with CARP and in advocacy within the industry. I don't know how you can get 13% return. Maybe I should talk to you to get advice from you
My advisor
afterward,
as well.
because I don't honestly believe that kind of return is sustainable. I think it might be.
I've given you my books in the past,
Yeah,
and
but
I've read your books as well.
yeah, but it's the sort of thing where you can't.
And what gets in the way of making money is that you're having to pay investment advisors, and that right off the top is cutting in. If I'm getting 5% and I have to pay 2.5% to an investment advisor, I'm only getting 2.5%. I think the average investor is lucky to get 1% gain on their portfolio in a year. And I hear things say, well, at 65, you're going to get, 6.5% back for the rest of your life. And inflation's going at 3.5%. So that isn't going to last very long at that rate. You've got to have capital gain inside your portfolio, or you are going to be screwed, and that's the way it is.
So I wanted to get back to the second point, because I half agree with you about the financial services industry. I think we could do a better job of educating people. And I think that I've written about that fairly extensively and have been quite critical about that. But it's not for everyone. Not everyone has your capacity to do what you do, and it's great that you can, and if you can, you should. And I actively encourage people, if they are capable of doing things on their own, I tell them they should. Unfortunately, a very large number of Canadians, and certainly a very large number of CARP members, just simply cannot. They feel overwhelmed. And for those people, getting advice and paying for it is almost certainly going to be better than muddling through on their own and almost certainly making mistakes that will likely be more costly.
I put my financial advisor in the same group as my electrician, my plumber, and my barber. Things I don't want to do on my own, I'm not trained to do, but I understand there's a fee that goes along with those services they provide me. I expect some return on that. I expect them to do a good job for me, but that's a profession.
And the gentleman asking the question is in a very lucky situation. To be able to retire and years later have, it sounds like 5 times as much as you started with that retirement, that's wonderful, and hopefully it allows you to live a very full life. There's many people who, unfortunately, what they've saved as they go into retirement, they can't live off a portion of the returns, it sounds like you have. And so longevity pension fund is not for everyone. People that are extremely wealthy don't need the risk pooling that this brings. They're able to live off the returns. Now, if you found a 13% risk-free investment, that's fantastic. I don't know that those exist, and I would speculate that maybe there is some risk that so far you've navigated very well. But as we look at the moment we're in right now and where markets could be going, not the next few months, the next 20 years, it may not be as kind to investors. And so that's what we're trying to help people protect for. And that's where longevity risk pooling does solve the problem that it sounds like you don't face.
Well, David, maybe weigh in a bit on what our members are telling us now about that real concern today about the inflation, the increased cost of living, and they're saving their nest egg not going as far in the future with inflation.
The real problem was perfectly illustrated by the dialogue we just saw, and that is that one size does not fit all. The dilemma, if you will, of, hey, it used to be 65 plus 10, 12 years, now it's 65 plus 20, 30 years for many people. That both opportunity, gift, and dilemma is there. It's an absolute, it's just the way it is. Now, how do you approach that yourself? What is your risk threshold? What is your investment knowledge? How much are you prepared to pay to an advisor, and what are you looking for in return? These are problems that have to be solved by the individual. And I think that, otherwise this new fund would have 100% share of market, and it won't. And I say that, I think quite confidently, it is not for everyone. But what is for everyone is the thought process, the planning process, and the being open to different possible solutions to your situation. And I think that a wider basket of solutions is where you're going to find the sweet spot for most people. It may be a continuation of earning an income in some way. It may be cold turkey stopping it all and having an income fund come in. You may already have a defined benefit pension from a corporation, lucky you. It may be lots of different things. It may be converting your home into cash, either through selling it or or a reverse mortgage or a HELOC. You have to be open and you have to get involved more. It isn't just that investment used to produce 3%. Now I got one that produces 6%. I don't even want to know anything more. And many people may look at it that way. But I think what we're seeing at CARP is when I take a look at people still working, when I take a look at aging in place, which is a huge issue. We keep doing webinars on it. We're never going to run out of material. Those also factor in. So you have to look at what is not just, hey, it's 20 years, therefore 20 columns on the spreadsheet. What are those years? What do they look like? What shape am I in now? What are my resources now? What do I want to do? What have I always dreamed of doing? All of that goes into the plan. So I'm just a consistent voice for make the plan as robust as you can. And then the investment vehicles will fit in. You'll find your way to the right ones.
And John, we do have a diverse audience here, and I'm hearing from a number of people who may be already too old for this product. So can you just talk to them a bit about longevity minus purpose, but what they might look into by way of planning for that longevity if they're out of your pool already?
The first thing I would say is build a balanced portfolio that's suited to your circumstances. So everyone has a different risk tolerance, a different risk capacity, depending on the pool of capital and how long they think they're going to live and how much risk they can tolerate in terms of the fluctuations of the market. So you have to build a portfolio that makes sense for your needs. For instance, a lot of people would say a traditional balanced portfolio is 60% stocks, 40% bonds. And some people, not all, but some would say as you get older, you might wish to be more conservative. But the problem with that is, as you get more conservative, at the same time, we're all living longer. And so if you would think that if 60-40 is considered to be appropriate for the old days, when you retired at 65 and died at 72 or 73, that's fine and well. But 60-40, even if you're 80 years old, you might live to be 95. You actually have a longer life expectancy ahead of you at age 80 today than you might have had at age 65 a generation or two ago. So you need to think about it sort of coherently. I'm not going to say deeply. You can think, make your own determinations about how much risk you're prepared to take and how you're going to deal with it and how you're going to offset it. And there are trade-offs. But be careful, but be diversified. More than anything else, be diversified.
Okay. And Fraser, the last question that I had missed was if someone's 65 and they have money in their RSP now, they've got until 71 until it converts to a RIF. They could take some of the investments they have now in RSPs, put some of that into their longevity mutual fund.
That's right.
And then when it converts to a RIF, what happens to it then?
The RIF and RSP structure are account wrappers that sit around the fund. And so once they're in a RIF, they need to start withdrawing. And we've actually incorporated that into our income policy. So the fund will always pay at the RIF minimum withdrawal levels, which is really helpful. We were getting a lot of questions from investors nervous. What if I need to withdraw more than longevity is paying? And so we factored that in, and people can rest assured that it will pay at that level.
Well, John, well, that's part of our advocacy is trying to get rid of the mandatory RIF withdrawals from CARP because people should be able to get their money when they need it, not when the government tells them they should take it out.
Yeah.
Go ahead. You add something else?
Well, I was going to say that you don't have to have, obviously, in many instances, in most instances, this will not be the only product in the RIF. So you can also take other things out. And back to the question 10 minutes or so ago about the tax treatment, a lot of it is considered a return of capital at the beginning when you have it in a non-registered account. In a taxable account, in a RIF, when you start making withdrawal, whether that money comes from the purpose fund or from a GIC or from a stock that you sell or from a dividend that you get, whenever you take money out of a RIF, it's added as it's part of your regular taxable income. So irrespective of what the tax treatment would have been, otherwise, as soon as you're taking the money out of the RIF, keep the money in the RIF, there's no problem. But as soon as you take money out of the RIF, no matter where it came from, it's taxed as regular income.
If it was in that TFSA, different treatment, but in the RIFs is not. I think we're just about out of time. So David Kravitz, thank you very much for joining us. Do you have any last comment to give us before we head out?
No, all I want to say is I think this is indicative of how we're going to be coming at this topic more and more in the future. Just think about the title, The Gift of Longevity. When would we have ever thought that outliving your money was a realistic problem for so many people? I say it's a realistic opportunity for so many people, but I think this is just the tip of the iceberg. We could do this again. I hope we will convene again. and thank everybody for taking part, and I enjoyed it. Thank you.
We had lots of questions coming in. I hope we do it again. John, question, final words for you?
My last word is it's sort of like the old hair club for men commercials. You know, I'm not only the president, I'm also a customer. I not only tell people that they should consider retiring later. I used to tell people I was going to retire early to freak them out and say that I was going to retire at 65. I'm now telling people I fully intend to work to age 70, and if I adjust that date at all, it'll be higher still. So I'm actively thinking about the things that we're talking about here today personally. I'm not just saying this to my clients. I live it. I really enjoy what I do. It's not that taxing emotionally or physically. So why not stay involved and work longer, because I expect to live longer too.
Yeah. Fraser, last word from you.
Yeah, I think it's just that you're not an average, and that's critical. Playing to averages is challenging. Playing to a wide range of possible outcomes is what longevity is all about. I realize also that today I didn't go into the fund details and construct, and so on our website, retirewithlongevity.com, there's some great videos, there's some great descriptions, and I encourage people to come there. If it's not clear from that, we're happy to reach out. We've got a great team ready to take people's calls if they're interested.
Great. There's more details about the Purpose Longevity Fund on the carp.ca website. We will also share this video along with the full video of Moses Neimer and Sam Safe. And we'll hope to reconvene again sometime soon and answer any more questions. So thank you very much to the hundreds who joined us by webinar. Thanks to our audience here at the Zoomerplex, and we'll talk to you again soon. Thanks very much, everyone. Good day.
Thanks, everyone.
Thanks, David.
Thanks, David.